Welcome to this tutorial on PUC or paid up capital. So what is paid up capital? Well, paid up capital is purely just the tax concept, and it represents the amount that can be returned by the corporation to the shareholders tax-free. Now, PUC initially starts off as the legal stated capital for the shares that were issued, and this is the amount that's stated on the financial statements. So initially, PUC will be the same as what's reported on the financial statements as the value of the shares. Now later on, there could be adjustments under the Income Tax Act to the PUC. Now, PUC is something that is purely related just to tax. So PUC will not show up on the financial statements. It will be tracked by the corporation separately from the value of the shares on the financial statements. Now, initially when the shares are issued, the PUC will be what the fair market value is of the consideration received for issuing those shares. So if a company issues 1,000 common shares for $2,000 cash, the cash will be the PUC. Now, the adjusted cost base to the shareholder will initially start off as the same amount as well. The $2,000 is what the shareholder paid for those shares. Now, later on, the PUC could change. Now, the adjustments to the paid up capital will be different from the adjustments that could happen to the adjusted cost base. Now, initially, when the shares are issued, the legal stated capital is the initial value of the PUC. While the legal stated capital does not change, the PUC could change later on. Now, one thing to note is that the adjusted cost base is often different for each shareholder. So if I buy shares in Apple for $100 per share, that's my adjusted cost base. Somebody else could buy shares a year later in Apple for $200 per share. That would be their adjusted cost base. So the adjusted cost base will be different for every shareholder. Now, PUC is calculated for the entire class of shares. So the PUC per share will be the same for all shareholders, while the adjusted cost base could be different for each shareholder. So that's important to keep in mind. Moving on to the next slide. When could PUC change? Well, PUC could change when there are certain share transactions when you're dealing directly with the corporation. So if the corporation issues or redeems shares, the total PUC for that class of shares could change. Now, PUC also changes when there are rollovers. Rollovers are when there are exchanges of shares for assets that are owned by the shareholder. So the shareholder will give assets to the corporation and in return will get shares. Moving on, why does PUC matter? Well, once again, PUC is the amount that can be returned to the shareholders tax-free. Now, PUC basically represents the value of the shareholders the value of the assets the shareholders initially gave the corporation. And so if the corporation buys back the shares, PUC is the amount that can be returned tax-free because that was the amount that the shareholders initially gave in assets to the corporation. Another point is that PUC is only relevant when the shareholder is interacting directly with the corporation. So PUC is only relevant if the shareholder, let's say, wants to have their shares redeemed by the corporation, then that would be when PUC is relevant. If the shareholder, let's say, buys shares in the corporation in the open market and then later sells the shares in the open market and is not interacting directly with the corporation, then PUC is not relevant. In that case, the adjusted cost base would be relevant to the shareholder in determining whether they have a capital gain or capital loss. Now, there's also this concept of deemed dividend. Deemed dividend is not an actual dividend, but it's treated as a dividend, and it could be when there's an increase in value to the shareholders. When there is a deemed dividend, the corporation will designate the deemed dividend as either eligible or non-eligible, and the shareholder will be taxed on that dividend directly, even if they may not have received any actual cash or assets for that deemed dividend. Now, deemed dividend could also occur when the corporation has an increase in net assets that is less than the value of the shares issued, the value of the PUC that was issued for the share. So keep this in mind. We'll see this concept of deemed dividend as we go through some examples. So moving on to the next slide, let's go through example number 1. Remember, PUC is the value of the assets that the shareholder gave to the corporation in exchange for shares. So let's say Zoom Corporation issues 1,000 Class A shares to Frank for $2,000. Now Frank's adjusted cost base, what Frank paid for the shares, $2,000 divided by the 1,000 shares, Frank is going to have an adjusted cost base of $2 per share. Now the PUC is the value for the entire class. So the Class A shares have a total value of $2,000. That represents the assets that were given to the corporation in exchange for the shares. And so in this example, the PUC per share is also $2 per share. Let's say later on, Zoom issues a notes payable for $5,000. So right after these two transactions, this is what the balance sheet would look like. Zoom has cash of $7,000, they have a liability notes payable of $5,000, and they have issued shares of $2,000. Moving on to the next slide, this is again what the balance sheet looks like after those two transactions. Now let's say Frank, who has the 1,000 Class A shares and paid $2,000 for those shares, let's say Frank sells the 1,000 shares to Shelley for $5 per share. So just a theoretical example. So Frank is going to sell the 1,000 shares to Shelley for $5 per share for a total of $5,000. Now, the corporation is not involved. So the only relevant amount to Frank would be what is his adjusted cost base. That's going to help us determine that Frank has a taxable capital gain of $1,500. Frank sold the shares for $5,000, bought them for $2,000, so has a capital gain of $3,000, of which 50% is taxable. Now, Shelley will have bought the shares for $5,000, so her adjusted cost base is going to be $5 per share. Now, the PUC per share has not changed. Now, remember, the PUC is what was the original amount of the assets that were given to the company in exchange for those shares. And initially, Frank, when the shares were issued, gave $2,000 to the company. So the PUC per share is still $2 per share. That has not changed, but Shelley's adjusted cost base of $5 per share is different from the PUC per share. Now, let's continue on with this example on the next slide. And let's say now this is 1 year later. So this is 1 year later. This is what the balance sheet looks like. The company has cash, inventory, capital assets. Also, the notes payable is still there. Retained earnings are now $70,000. And we still have those Class A shares that were originally issued for $2,000. Now, Shelley owns the 1,000 shares. Her adjusted cost base is $5 per share. And remember, the PUC is $2 per share. Now, let's say Shelley wants to get rid of some of her shares, but she can't find anyone to buy them from her. So the company agrees to redeem 500 of the shares for $6 per share, which is going to be a total of $3,000. So PUC will now be relevant because the shareholder is interacting directly with the company. So Zoom is going to buy back, redeem 500 shares from Shelley, and is going to give her $6 per share. So Zoom is going to give her $3,000 cash. Now, if we look at it per share, Shelley's going to get $6 per share. The amount that can be returned to her tax-free, the PUC, is $2 per share. So she is now going to be deemed to have received a dividend of $4 per share. If we look at that for all 500 shares, her deemed dividend will be $2,000. She's going to get $6 cash per share for 500 shares. She's going to get $3,000. Her PUC is $2 per share at 500 shares. That's going to be $1,000. So she's now going to have a deemed dividend of $2,000. And once again, Zoom is going to have to designate that as either an eligible or non-eligible dividend, and Shelley will have to include that dividend in her income. Now, because Shelley is essentially disposing of 500 shares, she's also going to have a disposition. Now, the proceeds of disposition is going to be altered because of this deemed dividend. She's going to receive $3,000 cash. However, because she's going to be taxed for a deemed dividend of $2,000, we don't want any double taxation, so her proceeds are going to be reduced by that $2,000 deemed dividend. So her deemed proceeds of disposition are going to be $1,000. Now, we're going to calculate whether she has a capital gain or loss based on her adjusted cost base. She's selling the 500 shares with a deemed disposition of a deemed proceeds of disposition of $1,000. Her adjusted cost base, she paid $5 per share times 500 shares. Her adjusted cost base is going to be $2,500. So she's also going to report a capital loss of $1,500, of which 50% is allowable. So let's think about this overall. Overall, she made $1 per share. She bought the shares for $5. She got $6 per share. So she made $1 per share on these 500 shares that were redeemed. So her overall gain was $500. For tax purposes, $2,000 will be treated as a deemed dividend, and that's going to be reduced by a $1,500 capital loss. So that's how the overall $500 will be treated for tax purposes. So once again, the PUC is relevant only when the shareholder is interacting directly with the company. Let's move on to the next slide and let's look at another example. Let's say Beta Corporation issues 1,000 Class A shares to Zelda for $2,000. So Zelda is going to have an adjusted cost base of $2 per share. And let's say, and then also the PUC of the shares will be $2,000. Now, let's say Beta issues a notes payable for $5,000. And let's say 1 year later, this is what the balance sheet looks like. So the company Beta has cash, inventory, and capital assets. It has, on the liability side, a notes payable, and also under shareholders' equity, retained earnings, and the Class A shares. Moving on to the next slide. Let's say, now once again, Zelda has the 1,000 shares, and the adjusted cost base is $2. The PUC is also $2. Let's say the note holder agrees to convert the $5,000 notes payable into Class A shares, 2,000 Class A shares with a PUC of 5,000. Now, from the corporation's perspective, they're reducing a liability. They're reducing a liability by $5,000, so their net assets will increase by $5,000. Net assets, once again, is assets minus liabilities. Because we're reducing a liability by $5,000, that's going to increase the net assets by $5,000. And that is going to equal the PUC of the shares that are being issued. And so remember when we talked about a deemed dividend back at the beginning of this lecture, we said that if the net assets are less than the PUC of the shares that are being issued, there's a deemed dividend. In this case, the net assets increase is the same as the PUC increase, so there's no deemed dividend. Now the Class A shares are going to have a total PUC of 5,000. Now remember, PUC equals the value of the assets that were given to the corporation in exchange for the share. So let's recap how we got that 7,000. The 7,000 was the original $2,000 cash that Zelda gave the corporation, and also the conversion of the $5,000 notes payable. So the net assets, the total value of the assets that were given to Beta for the $3,000 shares was $7,000. That's how we get the total PUC of $7,000. Now, the PUC per share is the same for all the shareholders. So for Zelda and also the new shareholders, the PUC per share is $2.33 approximately. Moving on to the next slide, let's have a short recap. The Class A shares, there's $3,000 shares for a total PUC of $7,000. The PUC per share is approximately $2.33. Now, Zelda's ACB, what she paid for the shares is $2 per share. Now, her PUC per share is now different because the PUC per share is the same for all the shareholders holding those Class A shares. Now, let's say Beta is going to redeem all of Zelda's 1,000 shares for $3 per share. Now, because Zelda is interacting directly with Beta, the corporation, the PUC is now relevant. The total cash that Zelda receives, $3,000, less the amount that can be returned to her tax-free, which is the PUC amount, 1,000 times 2.333 per share, that amount can be returned to her tax-free. The excess, $667, is a deemed dividend because she's interacting directly with the corporation. Now, because she is also selling her shares or disposing of her shares, there's going to be possibly a capital gain or capital loss. Now, the proceeds of disposition, the amount of cash she's going to get, $3,000, will have to be adjusted for the deemed dividend because they don't want to be taxing her twice on the $667. So her actual proceeds of $3,000 minus the deemed dividend is going to give her proceeds of disposition of $2,333. Now, in order to determine her capital gain or capital loss, we're going to have to now take into account her adjusted cost base. So her deemed proceeds of disposition, $2,333, minus her adjusted cost base of $2 per share. So her adjusted cost base is going to be $2,000. She's also going to get a capital gain of $333, of which 50% is taxable. So let's look at this overall. She basically made $1,000. She received $3,000. She only paid $2,000 on the shares, so she made $1,000. For tax purposes, though, $667 will be treated as a deemed dividend, and $333 will be treated as a capital gain, of which 50% will be taxable. So this is how PUC could be relevant when a shareholder is dealing directly with the corporation. Let's move on to the next slide, and let's look at example number 3 with some revised facts. So we're going to go back to Beta Corporation and also Zelda, and this is the balance sheet that we saw earlier. Now, Zelda owns the 1,000 shares. She paid $2,000 for the shares, so the adjusted cost base is $2. And at this point, the PUC is also $2. Now, we're also going to have the note holder convert the notes payable into shares, but in this example, the value of the shares, or the PUC per share, or the PUC for the shares is $8,000, not $5,000. So let's say that the note holder agreed to eliminate the liability, the notes payable of $5,000, but let's say the note holder said to the company, well, we're going to be giving up all these future years of interest, so we want to make sure that we get shares with a greater value than $5,000. So the shareholders, the shares that were given to the note holder, the 2,000 shares, had a total PUC of $8,000. So this is an example where there is now a deemed dividend. The net assets, the corporation is getting a reduction to liabilities of $5,000, so the net assets will increase by $5,000, but the PUC that's given to the shareholders have a value of $8,000. So the shareholders collectively are getting an increase of $3,000 in value. So there is now what we call a deemed dividend. Shareholders are getting $8,000 in value in the shares, but are only giving up $5,000 of net assets by the elimination of the notes payable. So now we have this $3,000 deemed dividend. Let's look at the total PUC first. The total PUC now is going to be $10,000. The shareholders only gave up assets of $7,000. The $2,000 that Zelda initially paid for her shares, and the $5,000 notes payable that was eliminated. So the net assets only increased by $7,000, whereas the PUC is now $10,000. So that $3,000 must now be taxed, because now the PUC is $10,000, and that's the amount that can be returned to the taxpayer, or the shareholders, free of tax. But the shareholders only gave up $7,000 of net assets. So that $3,000 is going to be taxed, moving on to the next slide, as a deemed dividend. But the deemed dividend is going to be taxed on all 3,000 shares, not just the shares that the note holders received, but to all 3,000 shares. So every share will have a deemed dividend of $1 per share. So that means that even Zelda, who owns 1,000 shares, is going to be liable for a deemed dividend of $1 per share. So her total deemed dividend is going to be $1,000. Now, because she's going to be taxed on this $1,000 deemed dividend, her adjusted cost base can now be increased by the dollar deemed dividend per share. So she's going to be made liable to include this dollar deemed dividend per share in her income. She's going to be taxed on it. And so in order to make that fair, her adjusted cost base is going to be increased by that $1 deemed dividend. So now her adjusted cost base is going to be $3 per share. Now, the PUC per share is calculated for the entire class of shares. So remember, we said the PUC is now going to be $10,000. There's 3,000 shares, and so the PUC per share is $3.33 per share. So Zelda's ACB of $3 per share will now differ from the PUC per share. So this is an example of how the ACB that the Zelda has could be different from the PUC per share. So this is going to bring us now to the conclusion of this short tutorial on paid up capital and also the introduction of deemed dividends. So some things to keep in mind. PUC is the amount that can be returned by the corporation to the shareholders free of tax. Initially, when the shares are issued, the PUC will equal the value of the shares. Now, over the life of the shares, the PUC will differ from the adjusted cost base. So shareholders will have the same PUC per share, but the adjusted cost base per share could differ from shareholder to shareholder. And once again, the final thing to note is that PUC is relevant when the shareholder interacts directly with the corporation. If a shareholder buys shares in the open market and sells the shares in the open market, PUC will not be relevant. PUC is only relevant when the shareholder is dealing directly with the corporation. So this brings us to the end of this short tutorial on paid up capital. Good luck with your studies.